Hi, everyone. Tom from DFINITY, which is a new blockchain protocol. So what I want to do is, I think you've listened to an interesting talk this morning about tokens, utility tokens, asset investment. I wanted us to take a step back and talk a little about abstracting away what exactly crypto as an industry. I've been in the industry for the last 5 years now. It's a long time. And I want to see how is it transforming our society. So we call it a crypto capitalism. And interesting enough, I come from an ex-communism country, China. So there's a massive transformation that happened. 1990s roughly the time, a little bit that I was born, a little bit earlier than that, but that's in 20 years you can see one of the most profound changes in economic history via a directional kind of change to free markets. What I would like to suggest, I think, what we are experiencing now is crypto as a technology, as a horizontal technology, as a way of thinking, is perhaps transforming our society and economy in an even more profound way. And so let's start with that. So before we talk about how to transform, it's useful to understand, maybe it's easier to stand here, what exactly is capitalism? And I'm thinking from an engineering perspective, how are we going to reverse engineer capitalism? Capitalism is really a couple of layers. If you think about you're going to recreate a capitalism structure, you're probably going to start with the very basics, which is the money, the idea of money. And by money, I don't really mean just like Bitcoin. I mean, there's an array of instruments that constructs the very core component of money. Once you have money, you create financial infrastructures around it. These financial infrastructure are for moving money around and for funding, investment, and supporting, so you can move values and funding the right things. Outside of financial infrastructure, you're going to have this idea of theory of firms, or the basic building blocks of organizations. And at the outermost of the circle, you're going to have boundaries and constraints, regulations, which are created by governments, typically, and regulatory agencies. So let's start with the money part. And obviously, the crypto overlay is really just on top of the existing physical layer, rather than replacing them. So the first part is money. What exactly is money? Bitcoin kind of ignited a lot of thinking around, forced us to rethink what exactly the fundamental of money. I guess one way to describe money is the broadest social contract that we all accept and kind of take for granted, and it's essentially a debt, a IOU, a promise, in which we agree to trade with our future society. Our future society says, basically, if you accept money today for your work or labor, you are able to redeem it for some other goods or services unspecified without a clear expiry date, and you can redeem it for something else. So the key property being no expiry date, arbitrary goods or services, undetermined quantity, and undetermined counterparty. So it's the broadest base, least common denominator that accepted by the society. Now, specifically to crypto, the first thing we see in the crypto that appears, not surprisingly, is a commodity money, as defined in roughly as a rather inelastic supply. It's a static supply. Bitcoin has 21 million, Litecoin 84 million, Ethereum, some fixed supply curve of fixed inflation every year. Now, that's useful. They're used for store value. They're kind of useful for medium exchange. They're not so good for unit of count. And that's one of the reasons I think underpins why there's not much real usage other than funding ICO and CryptoKitties. What exactly is the common between CryptoKitties and ICO? They are super speculative. They're more speculative than the underlying base commodity money. That's okay. We can fix that problem, and we're going to talk about that. The second type of money, and going to see a lot more, is crypto credit money. The idea of credit money, which is the underpinning of the modern commercial bank money, credit money, since then, especially post-1974 Bretton Woods Agreement kind of dissolving, is the idea that the economy should be elastic. And that elasticity should be based upon the real-world demand. It's not a fixed random number that is picked by central bankers or some arbitrary engineers. It's elastic based upon the real-world demand. And the basic way that commercial banks work is that they expand their money supply based on how much loans are being requested. And they approve loans based on loan quality, entrepreneur quality, and et cetera. And by doing that at a local level, at a branch level, they are expanding the money supply. That is driving majority of the money supply, rather than the common myth where central bankers had Fed or People's Bank of China are deciding to supply. It's actually the commercial bank. It's actually decentralized in some sense. Similarly, we can create similar structure in the crypto world by being elastic. And there are three major categories right now. The first category is a complete uncollateralized credit money. For example, Basecoin. Some of you probably heard of Basecoin. The idea is essentially you create an algorithmic version of that. However, it does not have a collateral. And that's one of the risks that I wouldn't expand too much into it, but that's one category. Second category, commodity collateralized, or crypto commodity collateralized. The way to think about it is essentially you have a smart contract that holds some amount of money, it's called MakerDAO, which I think right now takes Ether for the most part, as collateral. And the more you borrow against that smart contract, which is kind of serves as an algorithmic central bank, the more position you can borrow the DAI, which is the stable coin that is pegged to dollars, but it could easily expect to euros and pounds and other instruments. The third category, which DFINITY project kind of involves in incubating, is a project called FI, which instead of collateralized by commodity that is on-chain, which is endogenous and kind of risky in its own way. Imagine when large orders of Bitcoin to Ether being dumped on smart contract is probably not particularly useful for stability, is you collateralized by real-world loans. So without expanding too much into the details, these are three categories that you could potentially do a on-chain algorithmic commercial bank or central bank in some way. So that would be the easy phase one, which essentially you have an elastic money that can be used as a stable unit of account, which is the three, if we review about three basic functions of currency, unit account, store value, and unit exchange. The main missing part is unit account. And unit account has to be correlated with store value. That's the only way you can do proper on-chain blockchain economy beyond just speculation. And over time, you could even move on to an independent monetary policy. What that means is that instead of pegging against dollar, which is kind of useful, probably for a fairly long time, you could also decide to compete and have alternative monetary policy. You may not like, for example, quantitative easing policy from Fed, or you may prefer your own version of that. You could do that with independent monetary policy, but that's based upon certain adoption level. So that gives you a sense of the crypto commodity money that we have today is not the only answer. It's just a start. To move to proper economy, we would also want a more elastic money supply. Now, that's money, as we talk about, is the broadest layer of settlement layer. That the economy that you're participating, you have to use a base. It gives you high liquidity, it gives you easy settlement, but it doesn't really give you incentives to work on the economy because your marginal contribution to dollar is going to be minimal. By holding dollar, it doesn't give you any way to grow your business or grow your personal network. So you need local incentives. So then we go down one layer and think about what exactly is the basic organization, units of organization that we can create a part of the economy. So just review a little bit about the basic idea of theory of firm. Theory of firm is a set of ideas that have been kind of discovered or discussed about by economists since the 1930s, 1950s. What exactly does a company do? A firm do a couple of things. Why don't we just all be independent contractors and form an independent economy? The reason is because firm, they are lower transaction costs internally. They have lower friction. That's one of the fundamental reasons. They also have a shared output. By being a part of Google, I get the shared output of Google instead of me being the only player and contracting with each other. You also have better alignment incentives, et cetera, et cetera. Now, however, these theories all kind of make sense, still makes a lot of sense today, but we have found better ways. We have found more flexible ways using on-chain DAO smart contracts to form a more flexible unit. It doesn't have to be a legal entity anymore. So let's compare. In the traditional classic firm model, you at least have three basic entities of incentives. You have the idea of a company has an equity, right? You have a percentage ownership of a company. If you're an employee or management or shareholder. And then you have a capital stock. The company has some money that can pay you and to expand its production, et cetera. And then you also have the kind of more abstract concept of boundary. Like what exactly forms a company? Are you an employee or are you a contractor or you're not? But it's a fairly strong and strict boundary. Like either you are part of a company or not. Customer, for example, are not considered part of the company, but your employees and shareholders are. Now, if you expand that model to the new peer model, right? When you think about Ethereum, who exactly is the employee of Ethereum or employee of a Bitcoin? It's really hard to define. You have a lot of peers. Some of them are more core. Some of them more thought leaders. So you have a lot of peers, really, and you have more like a hashtag model. Rather than in or out as a binary outcome, you have end users, developers, arbiters, activists, providers, miners. You have many of these roles, and each person might play multiple roles. Now, what exactly is that? What's the implication of that? Is in the company world, you really have two shades. probably kind of a bit high level, but roughly you have the company equity, and then you all the way head to money, right? There's not much incentives in between. Whereas in the token world, you have many, many different shades. I'm going to use a CryptoKitty as an example. So you have the very basic unit. A CryptoKitty could easily have a Kitty usage token. That user token allows you to trade or own a CryptoKitty. But then you could also have a developer token. That developer token may have a slightly different boundary and requirements. If you're a developer who is contributing a CryptoKitty source code, you might have to own certain dev token. However, to align your incentive better, you could arbitrarily say that every developer must own a minimum holding period, lock-in period of 18 months instead of a completely dynamic membership set as compared to the user token. And then you could further say we have a higher class of token called Kitty voting token. And inside a Kitty voting token, I could even separate two subgroups. There's the short hair working group, cat working group, and there's a bobtail working group. And they have different boundaries, right? You could say, okay, the bobtail is a completely closed working group. It has to be vetted by previous members. You could define these permissions arbitrarily based on the actual needs. And certain core groups are more critical to the ecosystem and some are not. So that's kind of the information from the project perspective. Remember that previously in the company world, when you think about if you're part of the Uber company and you're an employee, all you own is Uber, the equity. But what about the industry as a whole? What about ride-sharing company as a whole? Could you benefit as a part of the larger industry? Well, you kind of have a loose partnership between Uber and maybe some other companies or Lyft, but you don't really have a direct equity ownership there. Now, in the DAO, in the kind of on-chain world, you could do that too. You could make the Kitty tokens are convertible at certain fixed exchange rate or dynamic exchange rate to, for example, a crypto pats association token. So by holding these tokens, you're not benefiting only from your specific project. You could also benefit from a broader growth of the industry. So that kind of gives you a sense of the arbitrary kind of the flexible rules that you could create and incentives more than just a traditional equity and debt structure. And the second part, am I running out of time? All right, I'm just going to end with the last slides. Sorry, I'm going to skip a little bit on the software part. So previously we have talked a lot about the software and the virtual software. In my view, just to be simply, I think the software actually has a massive overfunding problem. I don't think we have a lack of funding, especially compared to the talent level. So I think there's a new interesting development that happening with a crypto model is actually the impact of crypto capitalism is far beyond software. One example would be on drug development. So drug, for example, takes a massive amount of funding. A clinical trial easily costs $50 to $100 million. And they're massively underfunded today, mostly by big pharmas, monopolized by big pharmas. Drug also has an interesting conundrum of having the Arum's law rather than the Moore's law. Moore's law says that computational costs get cheaper. Arum's law actually said it's a reverse. The drug got more and more expensive for many different reasons. Now you could actually use tokenized model to tokenize all the clinical trial data, a very, very specific type of assets, the most expensive assets within the funding process, and all the token funders could get rewarded when a big pharma pass the drug and start selling the drug for massive profits. So that gives you a sense of, I think, changes happening beyond software. I think I'm going to end here, but yeah, that's my sharing. Thanks.